committee's considerations. The Monetary Policy Committee recognized the weak macroeconomic environment as reflected particularly in increasing inflationary pressures and contraction in real output growth. In view of this, the MPC underscored the imperative of coordinated action anchored by fiscal policy to initiate recovery at the earliest possible time. Members called on the federal government to fast-track the implementation of the 2016 budget in order to stimulate economic activity, to bridge the output gap, and create employment. In the same vein, MPC expressed concern over non-payment of salaries in some states and urged action in that direction to help stimulate aggregate demand. On its part, and as a complementary measure, the MPC restated its commitment to measures and deployment of relevant instruments within its purview to complement fiscal policy with a view to restarting growth. The committee also enjoined deposit money banks to partner with government and the bank in this direction by redirecting credit from low employment generating sectors to those capable of supporting growth, reducing unemployment, and improving citizens' standard of living. Members agreed that the economy was passing through a difficult phase, dealing with critical supply gaps, and underscored the imperative of carefully navigating the policy space in order to engender growth and ensure price stability. The MPC therefore summarized the two policy options it was confronted with as restarting growth or fighting inflation. The MPC was particularly concerned that headline inflation spiked significantly in June 2016, approaching twice the size of the upper limit of the policy reference band. The committee noted that inflation had risen significantly, eroding real purchasing power of fixed income earners and dragging growth. The MPC was further concerned that while the situation called for obvious tightening of the monetary policy stance, the recession confronting the economy and the prospects of negative growth to year-end needed to be factored into the policy parameters. The arguments in favor of growth by the committee members were anchored on the premise that the current inflationary episode was largely structural. In particular, members noted the prominent role of cost factors arising from reform of the energy sector, leading to higher domestic fuel prices and electricity tariffs, and prolonged foreign exchange shortages arising from falling oil prices, leading to higher input costs, domestic fuel shortages, increased transportation costs, security challenges, reform of the foreign exchange market, reflected in high exchange rate pass-through to domestic prices of imports. Consequently, the current episode of inflation, being largely non-monetary, but largely structural, tightening at this point would only serve to worsen prospects of growth recovery, as the bank had in June 2016 withdrawn substantial domestic liquidity through the foreign exchange market upon the introduction of the flexible foreign exchange rate market regime. Members, however, noted the negative effects of inflation on consumption and investment decisions and its defining impact on the efficiency of resource allocation and investments. The Monetary Policy Committee further noted the prolonged non-payment of salaries, a development which has affected aggregate demand and worsened growth prospects. It also noted that at the May MPC meeting, members weighed the risks of balance of probabilities against growth and voted to hold, allowing fiscal policies some space to stimulate output with injections, but this has been long in coming. MPC also, on another hand, considered a high inflationary trend, which has culminated into negative real interest rates in the economy, noting that this was discouraging to savings. Members also noted that the negative real interest rates did not support the recent flexible foreign exchange market, as foreign investors' attitude had remained lukewarm, showing unwillingness in bringing in new capital under the circumstance. Members further noted that there existed a substantial amount of international capital in negative yielding investments globally, and Nigeria stood a chance of attracting such investments with sound macroeconomic policies put in place. Consequently, members were of the view that an upward adjustment in interest rates would strongly signal not only the bank's commitment to price stability, a major mandate of the central bank, but also its desire to gradually achieve positive real interest rates. Such a decision, it was argued, gives impetus to improving the liquidity of the foreign exchange market and the urgent need to deepen the market to ensure self-sustainability. Members were of the opinion that this will boost manufacturing and industrial output, thereby stimulating growth, which is desired at this time. The committee's decision. The MPC, recognizing that the bank lacked the instruments required to directly jumpstart growth, and being mindful not to calibrate its instrument in such a manner as to undermine its primary mandate and financial system stability, in assessment of the relevant issues, was of the view that the balance of risks remains tilted against price stability. Consequently, 5 members voted to raise monetary policy rate, while 3 voted to hold position. In summary, the MPC voted 1. To increase MPR by 200 basis points from 12% to 14%. 2. Retain the CRR at 22.5%. 3. Retain the liquidity ratio at 30%. And 4. Retain the asymmetric window at plus 200 basis points and minus 500 basis points around the MPR.